Well, good morning, traders. This is Blake, and you are listening to the F.A.C.E show. Dale has an internet outage right now, so unfortunately, he's not going to be here today. Good morning, team. Looks like Ryan and Cayman are here. Good morning, guys. And I don't hear from anybody else. Can you guys all hear me? Testing.
Yeah, what you meant. Morning.
Okay.
Morning, everybody.
Good. Good morning, guys. First of all, I gotta say I am really taken back by the events over the weekend. It was one of those situations that I think it's so horrible. And you sit there and you think, like, how in the hell did that happen? And that's kind of like where I've been all weekend, just trying to think. After I got back from some events on Saturday, I'm like, and I started to hear what was happening. I'm like, where's the breakdown there, and how did that happen? But anyway, it's a horrific horrific events that happened in Israel over the weekend. A lot of innocent lives have been lost, and we've seen some really big responses in the markets. And I think the biggest one, one of the bigger ones, is you've seen the gap higher in gold. You've seen a gap higher in crude, and we should probably talk about those really quick. And then, I'd love to get you guys' thoughts about a couple of different things here in a minute, but let me just start off with crude oil. So crude automatically gapped up, and you can see we rallied from $82 to 86. I think we need to be really careful, because if we get back above 88, that probably would signal to me. And I know I just updated, here in the ForexAnalytix platform, you just got this analysis as well, but I want to just kind of talk about it because I do think it's important. I think if crude oil starts to gap higher, that would suggest that the tensions are starting to rise in the Middle East, and it's probably probably going to signal to us, if we see a gap higher in crude or continue to move in crude, that things are escalating. And I think that between that, and then you look at gold also gapped up, and you can see we're developing like a bit of a bullish pennant. We start getting above 1860. That was the resistance I was looking at on Friday. I didn't think we'd be up there because of this reason. I thought it would be following the jobs report, we would be up at, probing 1860 as being resistance. You can see, that was the kind of, once we got past 1835, we were talking about 1860, and that is where we're at. And I think this is going to be a really important level to be watching. I'd be watching that just as closely as I'd be watching crude oil at this point. We should probably also take a look at yields. Yields are coming off because the dollar has firmed up. And if you guys haven't seen the dollar index, the dollar is not backing away, obviously, from the events over the weekend. You can see how we are holding well above 106 now, and we're nearing probably resistance here. So and going back to the bond market and yields, one of the other reasons why you would see yields coming off and the bond market holding steady is risk aversion. Why not look at some fixed income and say, okay, let's get out of this and take some, let's go ahead and pocket some of these yields from, quote unquote, a riskless investment, if you will. And so I'm sure you have a lot of people that are piling into the bond market this morning, just from a risk aversion standpoint. So anyway, Ryan, what do you make of all this, these events over the weekend? Crazy stuff, right?
Yeah, terrible stuff, and it's terrible on both sides, because it's all leaders doing this, and people are suffering both sides. So yeah, you never want to wake up to those sort of headlines anytime, no matter where it is or who it is or where it is. But we have to. From us, our point of view, we put it in a market slant, and we have to look at what the market moves are. You say gap up in oil, but it's not really taking off. Whether you call it fortunate or unfortunate, these incidents do happen over there, and they're not often that big a market impact. But it just maybe it's a bit different because of all the geopolitics going on elsewhere. You know, it plays into the rhetoric between US and Russia, US and China, and all the rest. You know, Israel will just working on a deal with Saudi Arabia. You know, has that now taken a step back over this sort of thing? So, yeah, it's going to be a bit dicey market wise over the next few days. Hopefully, things calm down and peace returns to the area. And
I was going to say, it just does seem like it has the risk of actually turning into a little bit of a bigger and broader war. You know, the problem is, and I'm just going to say from the US's point of view, and you know, the Biden administration, that guy doesn't even know his left foot from his right foot. And then now you got you know, the Russia Ukraine issue, you know, trying to deal with China, and now you have this on top of it. I mean, this is where you know, you know, a lot of forces are going to be stretched kind of thin dealing with this situation, right? So
yeah, very much so. Yeah.
What do you you know, here's the thing is I was sitting there last night, and then you go deep in the weeds, and I'm not a Middle East expert by any stretch of the means, but I try to think of it from a, you know, more political, or not political, militaristic type of point of view, based on my, you know, past life. Anyway, I'm like, I sit there and go, how in the hell where's the breakdown, the intelligence breakdown of this whole thing? And how did, with technology today, how did that actually happen? It had to be in some sort of intelligence breach somewhere. I don't know. And then a lot of people would speculate that it's more than that, and it, you know, maybe it's planned. And then you go down those rabbit holes, which is scary in itself. But anyway, K-Man, what are your thoughts here over the weekend with market reactions and everything else?
Yeah, again, we are no experts on what's happening there, and it's extremely horrible for the people involved, especially those who didn't ask for any of this. Oh, what are we doing? I don't know really. It all depends whether this thing escalates or not. I guess if you look at it from a pure market point of view, which we are traders, and we have to look at the implications of it. I think it depends how long it lasts, how that Hormuz Strait is going to develop, whether there's more Middle Eastern trouble coming, which would obviously heavily weigh on risk globally, would weigh on growth initially as well. But then, what do we make of it? To me, it's an extremely difficult call. So let's hope it all settles relatively soon, and then we can look at other stuff again. But I'm actually I understand people trying to get into bonds as a little bit of a safe haven thing, but then if worse comes to worse, war is extremely inflationary. So I don't know down to where those yields can go, or up to where the bond market can rally, to be honest. And therefore, I am traveling extremely light in these markets. I understand everything, but I don't know what's going to be the next one, you know. And yeah, I'm straight away going to reply to Scott, who says yen is a better haven. Well, look at dollar yen, mate. I mean, nothing's moved. We're 20 points lower. If you look at yen crosses are a bit lower because the rest is off, but the yen itself, dollar yen, hasn't really moved. Dollar Swiss seems to be the stronger one, where the people perhaps go a little more into that. I find it myself a bit strange as well that dollar yen is not lower, and especially if people buy bonds, push the yields lower. I find it a little strange, but yen has other stuff to other fish to fry. That's what we said on the flow show as well. And yeah, I don't know whether I want to trade yen on the back of this risk event.
Yeah. So I got a question from Jay, is how the dollar Canadian act with oil going up, and I think the Canadian will catch a bid as a result. You'll see this dollar Canadian probably trade back down towards this 136 level. We have this head and shoulder pattern in play, but you could choose to remove the dollar out of this. And I know K-Man, you were you and well, I'm short the Euro CAD as well, but you're looking at this on the short side too, correct?
Yeah, absolutely. There's this interesting level here around 143.80. We're right on it. I've already had a couple of attempts on it on Friday as well after the labor report. And if oil continues to pull higher together with that labor report, that should in theory put a bid on the Canadian dollar. So I think this one is vulnerable too.
Yeah, and you can see there's the 38% retracement right there, and if it breaches that level, we should it should open up some downside below 143. And that's one of the things, AJ, you don't have to always trade the dollar CAD. I like, for example, I was just in the you can see it in the oops, let me delete this really quick. I didn't mean to do that. Sorry, I just want to delete the drawings here. Okay, you can see in the ForexAnalytix trades room, I just took a short in the dollar Canadian at 138.61. So that was 10 pips ago. Just 24, less than 40 minutes ago. So you can see,
that was a good feel.
yeah, thanks. I mean, I'm wanted to get short some dollar CAD as a result, because I think crude oil is going to firm. And I don't think the situation is going to get any easier. So I look at the head and shoulder pattern. I still think we're going down, but you don't have to trade the dollar CAD. You could actually trade, the Euro CAD, CAD yen. There's other trades you could take as well. But I do have some Canadian exposure as well. So hopefully that makes some sense. Ryan, what are you thinking here? I mean, we're actually seeing stocks recover a little bit as North American traders are coming back in, and they're sitting in front of their computers. But remember, it is Columbus Day, so the bond markets are closed. We are going to see we're going to see equity markets respond. I'm not sure what they're going to do here, but the S&P is obviously set up and holding the 43.30 level. What do you think here? I mean, as North America comes online.
Yeah, it's a bit of a tough one today, isn't it? We've got all this going on, but then you've got half of the US out. Bond market's shut and everything. So, is there going to be a big appetite to trade? Are we maybe going to hit some liquidity air pockets, or are we not going to see anything at all? I'm just going to sit and watch and see if there's any levels tested around. We've got euro dollar still undecided whether it wants to do this 105 level. It's been holding it for now. But for stocks, we might just ping between the levels. Obviously into 4,200 is the big one at the moment. I think if you get a test down there today, that's just on these geopolitical headlines, you're probably going to be looking at that closely to try along. But it's a different kettle of fish when the market's in full steam and we're testing that again for whatever reason. Just watch your levels. If it's going to be a bit quiet, then the big levels tend to hold in times like that. And, you don't need to risk a lot. Just have a little trade. No need to get out your depth on any trades right now, and see what happens.
Yeah, I was going to say, I do think that we're kind of nestled here between the 43.30 level, 4,200 level. Friday was it was interesting. And this is going to be, let's talk about this, because this is something that I discussed on the week ahead video. and I want to make sure that everybody here, not everybody gets an opportunity to watch that week ahead video that I put together every weekend. But I did want to have this discussion. Having you guys here and hearing your thoughts about this is going to be important. Friday was great because we were like, okay, strong data, strong jobs data. We're going to see the dollar initially strengthen, but then we're going to start to see it weaken, which it did. The dollar really came off on Friday, as the markets looked at the economic data and said, well, hell, we're going to skate, maybe we'll skate in a recession. So CPI data is a little bit different. We do have CPI this week. Actually is it Wednesday? We have on Wednesday. Let me just confirm.
Thursday, PPI Wednesday, CPI Thursday. Usually it's the other way around, but yeah.
Yeah, weird, right? Like that. Well, usually we get exactly.
CPI, then PPI, yeah.
Yeah. Anyway, so Thursday we got CPI data. We're gonna have inflation data this week. But if the data is strong, that's good for the dollar, not so good for stocks. So
I think the reaction since the jobs report has been important because prior data, the last couple of weeks, it was good data. We made new highs in yields, the dollar made new highs. Now, something like a gangbuster NFP, and we can't make new highs. That's always a potential signal that, okay, the higher for longer message that we've been running for the last 2 weeks and trading the last 2 weeks or so is perhaps, now a bit more priced in and the market's happy with the level, and it's going to take something much extra to kick it into another gear. It's going to take CPI rocking much higher. Let me have a quick look what the early forecasts are for CPI.
So that's a good observation. Go ahead, Cayman.
That'll depend on which data. As we have been saying, and I said on Friday, a good labor report doesn't warrant low stocks or equity markets, and that's what happened. I think in turn a much higher CPI will be bad because that's 100%. The wrong reason. That then yields higher for the wrong reason, in my opinion.
Because CPI is expected to drop back a pip to 3.6 from 3.7. The core dropped to 4.1 from 4.3. Remember, we've had 2 months of higher CPI numbers. So if that surprises to the upside, that's going to be 3 months. That's now a trend in CPI. If it goes higher again, that's when you probably get an extra kicker in the dollar and yields and stuff. But if it comes in there or thereabouts, I can't see any reason why the dollar goes higher again.
Yeah, everybody really hopes that we're going to have like this deflationary type of data. That deflationary pressures are going to persist. And you're right. If inflation comes in hot, the stocks are not going to like that. So I had this conversation on the week ahead video. I had to set that aside and really have the discussion because, people get confused by, well, I don't get it. Strong data, we get this type of reaction, weak data, we get this type of reaction. But just think about how it's going to impact the economy in the state that we're in right now. It's different when you have like an economy that's thriving. Sometimes the Fed, and we've seen it over the last 20 years, the Fed and other central banks would have, totally wanted some firmer inflationary data. It would have been a confirmation that the economy is growing. But right now, inflation is just going to weigh on the consumer, and the consumer's tapped out as it is right now. Okay, great stuff, guys. Really appreciate it. So let me ask you this, since it's just the three of us right now, Ryan, what was your play this week? What is the play that you're looking at that you're like, okay, this is the trade that I've been thinking about and I'm so ready for it? So what are your thoughts?
Well, talking about CAD, Dollar-CAD is one. I mean, I've been more bullish on CAD for the last several weeks, but it seems every time of late I'm find myself long Dollar-CAD off the opportunities. But I'm thinking CAD might be a good one for a bit of a surprise turn from the Bank of Canada. They've already started indicating they're a bit more hawkish, but if it could force them into another hike. That might catch the market on the hop, and if the stars align with higher oil and a bit of weakness in the dollar, then this has got some decent downside. I know you're in already, but I'd like it a bit higher, maybe up to 138 to give it a crack. But need to have a look at that 137 at the moment. That's your marker right now. We're back below my trend line, which comes in around 136.90. I know you've had your one set high as we discussed last week. Mine's in 137.96 odd, call it that. So that's around the big figure. So that's what I'm looking at. I think Dollar-CAD is a potential opportunity this week.
Okay, yeah, and the whole Israeli situation has really put a different spin on the Canadian. Potentially this week. So interesting setup. What are you thinking, K-Man? What's your setup this week?
I think euro dollar is hasn't changed despite the rally on Friday. I think people were just buying dollars too high too fast on the data. But for as long as we are below 106.10, give it even to 106.25.40. On the euro dollar, I don't think the medium term has changed. I still think that we have a chance if we get back up there to reload some dollars. For the rest, it's going to be, I like the Canada as well. After again the very nice labor report, participation rate higher, even though it's not like that bullish on the part-time and full-time balance, but still there's creation on both sides, so that's still good. For the rest, it's going to be a tough call. We are sterling may be one because it's been hopping up and down this cable between the levels between this 120.60.80 and 123 figure 20. That may perhaps decide to pick a side sooner or later. There's a lot of meetings, political front and stuff, but there's a couple of data out as well. So I'm going to keep an eye on the sterling. It's either going to be a break trade or it gives you a nice 240 points to play inside as well. So that sterling cable may be one to keep an eye on. And for the rest, it's gonna come as it comes. I mean, there's going to be news. There's going to be CPI. Obviously, S&P 4,200 on the one side, and I have something just below as well. So I mean, this, what is it, 41.90, 41.80, something like that. I think that's so you can get in front of the 4,200 and you're stopped below 41.80 or so, which is nice and a good, well-defined level, and the top side 43.30, right? And right now, I don't know whether there's really much to do. That's the thing. We need to wait for the next headline to drop to take the different pairs or the S&P or gold, for instance, to the next back to the levels for the retest or for a break,
Yeah. All right. Well, thanks, Cayman. I was just reading the comments from Amira. So Amira, glad that you're okay in Israel. So thanks for checking in with us. We do appreciate it. And obviously we've been talking a lot about it over the last 20 minutes or so here on the show. It's just such a tragic event. Catherine had asked about the Euro Mexican peso and said, "Hey, Blake, K-Man, I'm surprised are you guys surprised there wasn't as huge of a reaction?" And I want to say, I'm just going to say this: the dollar Mexican peso is right up against really key resistance. Now, we do have inflation coming out here. Did it just come out?
It did pretty
Yeah.
much in line.
Okay.
PPI in line with the prior one on the month-on-month, ticking higher year over year, but the rest is relatively in line. There is no big shocks there.
Yeah, just looking through the data myself, because I forgot
dripping
it came
over
out
on the
just as
year
we
over
started.
year. Dripping over on the year over year. But to reply to what Catherine says, I think a lot has been done over the past week and a half on the MEX.
Right. Like look at this move already. I mean, if you're on the you know what has to happen, and this is my opinion here, K-Man, and you probably would agree with this. In order to get above like this major trend line, you can see that's capped us literally since 2021. In order to get us above 1850 on the dollar max, we have to see the S&P shitting the bed, like literally below 4,200. You start to see capital markets just taking a hit. You're going to see this accelerate, but I think people are pausing because it's gone so far in such a short period of time. But anyway.
I think there's been a massive exit of carry trades when the S&P started to come off, and people preferring to bank it. And there's still this nearshoring thing going on, which in theory, if there's no big dramas in the US markets, should sooner or later start to support the mix again. But then you have the rest of South America, which is starting to cut rates. And I think the market is a little bit in limbo here on the mix.
Yeah, and the other thing is, remember, like, you don't hold. I mean, I'll hold some positions in the Euromex or the dollar mex, but I'm not trading huge amounts of capital either. I'm trading individually. But for institutional, the real money out there, real money accounts, they're not going to be carrying anti-carry trades in their portfolios. They're just not. Like, no one's gonna carry a short Mexican position, long euro position for any extended period of time. So it has to be an event driven, Catherine. Like when I say event driven, there's got to be like a catalyst. Like, okay, the S&P looks like we're going from 4,200 to 3,900 right now for X, Y, and Z. And if that's the case, I'm gonna, liquidate my carry trades, A, but B, as a market, I'm here to take advantage of these moves. I'm not going to place those trades as an anti-carry trade unless there's a significant reason for me to do so. So anyway, that would just be my opinion there. Again.
Yeah, absolutely. But that's the thing. You could actually in carry trades, because the definition of a carry trade, it's a bit like a long only fund. You very rarely go short in those carry trades. You have to be long carry trades, because that's where you get the interest rate differentials. And we can't forget that after the pandemic, those people have been right for the past 3 years, right? I mean, the dollar mix, if you only take the dollar mix, don't even look at crosses, but the dollar mix came back down from 23 down to 17s. I mean, how about that for a carry trade, They probably didn't go in right after the pandemic, but even if you took only the second leg, which is from 22, they're not panicking. They're just going out of the carry trade. But the problem is they are so big that it makes the market move very, very rapidly, right?
Right. And Dimitri, just to explain to you like how big this level is. I mean, I even made it, this is pre CPI. I talked about it on the weekend video. This is like the really 1850, just such a critical level for the dollar max. So if we see that break, if you see like 1850 break in the dollar max, that's going to suggest to me if we haven't broken 4,200 in the S&P, we're probably going to be. Like, that's one of those, like, okay, that, you know, the major step in the FX market has been taken, and you know, we're probably going to be accelerating. So yeah, just watch that 1850 level. It's going to be big time. Hey, Dale is not here, and I know he had an interview set up, but I don't know Don. I said today's guest is Don. I have no idea who Don is. Does anybody know who Don is? Is Don here? All I see on the do you see a Don? Does anybody Don? If Don's not here, then I'm looking for a Don. Hold on, let me just Don Draper. Yes, Tony. Don Draper is totally here. I'm gonna steal his watch collection and then let him go. So is it Don Dawson? Don? I don't know. That's the only Don I see. Don's like, dude, that's not me. Wrong person. Just kidding. If Don is not here, then we're going to reschedule you because, like I said, well, Don, if you're listening in, let me just, yeah, Don. Hi, it's Don Dawson. Right. Don, were you supposed to be today's guest? Oh, well, looks like I'll take you. I have no idea who you are, so we're gonna have some time to talk. How about that? Well, guys and gals, I'm gonna let K-Man and Ryan get out of here, but you should all stick around because you're gonna be as surprised as I am to talk to Don. Right? So let's bring Don around. Let me figure this out.
Good day, guys.
All right, thanks, K-Man.
Yeah, cheers, guys.
Thanks, Ryan. Let me see here. Now I have to go find you. Don, you should be coming over. Let me see if that worked. Don, you should be able to speak. Don?
I think it's hooked up now.
Yeah, I can hear you. How you doing?
Doing good. Good. I thought
Great. I have no idea who you are. So tell me who you are and let me see if I can find you real quick on Twitter.
I don't do Twitter. So
you don't do Twitter.
I am not a social media fan. I do LinkedIn, but I am not a social media fan.
Well, okay. Well, tell us a little bit about yourself. What do you focus on? What do you do in the markets?
Okay, I've been trading since 1987. I've been registered as commodity trading advisor, has Series 3 broker's license, so on, all back in the day.
What a great year to get started.
Wasn't it? Yeah, I was literally about 3 months before the crash. And I just remember sitting there that day going, what the hell have I gotten into?
So, right. Okay.
Anyway, I was, self-taught trader about 5 years before I really could, feel like, okay, I think I can make a living at this. And I started out doing swing trades, trading commodity futures. That's my specialty. I really don't trade Forex. I trade Forex futures, but I don't do the Forex market itself.
Sure.
I always had issues with Forex with the regulation, and it was never regulated, and I'm a type person, I'm all about regulations. So that's what kind of kept me away from it for so many years. And also it really didn't become what Forex wasn't traded by the public until late 90s or something like that.
2001 in the US anyway. Yeah. Right. In the US, right. we had the ability to start trading. That's why I started trading currencies, is because it was fresh and it was new in the United States. So yeah. So you're commodities dude.
Yeah, I am. I do I don't day trade. I only do swing trades, and I do commodity spreads. That's another style of trade. And for example, I might be long, a new crop and an old crop of a grain of some type, corn or soybeans or something like that. Energy markets, I could be long, certain times of the year. You come in, you get, like, for example, Memorial Day, around January, you want to get long some May crude oil and short December, and that's usually a pretty good spread. So that's the kind of trading I do. It's longer term.
Got it. And by the way, did you want to show your charts, or you can take them. I can pull up things for you as we're going through them. Yep. It's up to you.
I was going to talk. I also something I've been doing recently. I taught classes for about 15 years on the futures market of teaching people to trade and stuff like that. I resigned from that about 2 years ago. And now what I do is just I trade, but I do articles. I write articles for barchart.com and do some futures market analyst work for different podcasts and stuff like that. So I just wrote an article this weekend I was going to talk about with the dollar for the fourth quarter coming up.
Love to talk about it. Let's talk about it. And by the way, I was just looking at the CFTC data on barchart.com, and I was just noticing that finally the euro longs are they haven't gotten to the institutional, or excuse me, the non-institutional large speculators have finally started, I want to say, capitulating. They're almost back to break even here as far as their positioning goes. But I was just looking at that before you came on here, ironically. So what do you make of the dollar, and what have you been writing about it?
Okay, well, I just wrote this weekend. Matter of fact, I'll just do a screen share here, and I'll take you out to bar chart and show you the article, and then we can just kind of go from there.
Yeah, sure. Go ahead. Take the screen.
Screen here, and there we go. And I don't see the green around my. Try something else on this share. Wrong one. Can you see the bar chart on your screen for me?
I can see bar chart premiere. So you look like you're going to search for a symbol.
Yeah, that was it exactly. So normally I have a green bar around this. That's why I was questioning it. Okay, so basically this is the bar chart website right here. And I just wanted to, if any of your listeners wanted to follow articles that I write, they can do that. And I'm just going to show them the process of doing that later on. But anyway, it's once you get to barchart.com, right up here, there's a place where it says news right in here. And you'll just click on that. And then over here on the left, it just says, featured article or authors right here. And then there's my name down here, just Don Dawson right here.
Oh, great. Okay.
And once you click on that, it'll list all the different articles. I don't know what's going. Oh, here we go. It'll go all the way back to 2 years worth of my articles I've written for them. I usually do a weekly articles for them. But this is the one I just did this weekend. I just wrote this one on the yield curve last week about, okay, so the yield curve is inverted, but when does the actually recession, when does that start? And it's a pretty good article. Well, I don't like to brag like that, but I'm just saying it's an article about a chart where the Federal Reserve called FRED, you can look at that, and is a really interesting concept. Let me show you that really quick, because it kind of ties into this article that we're going to do. Anyway, here it is. And this is the FRED chart right here. Now, I know this is only a handful of the gray boxes are the recent recessions that we have had. And then this is the inverted yield curve. Now, the yield curve I like to follow because there's so many different yield curve inversions. You hear people talking about the 2s and the 10s, the 5s and the 10s, and so on like that. This one is the one I keep on my charts from ever since the 80s. I have kept these on my charts because this has been the most reliable recession indicator that I can get. And also the Federal Reserve has written papers on this, that this is a particular spread that or yield curve that they like to watch. What's happened is you've heard in the past where people, will have like a 2 and a 10 will go inverted, or a 5 and a 10 will go inverted, but this 3-month Treasury bill and the 10-year Treasury doesn't go inverted. And then that's where the old saying comes out that not all inverted yield curves turn into a recession. And I agree 100% with that. But when this 10-year and the 3-month inverts, it's like a 99.9% we are getting a recession. Okay. This is like the last of the Mohicans that are going to get, it's going to go inverted. So if this one goes, it goes that deep of an inversion, we get the recession. Now, what this chart is showing you here is this gray area are the previous recessions that we had. This little dot dash right here for a recession was back during COVID. This was the shortest recession we ever had in history. And why? Because the government started coming in with all that helicopter money, giving money away, right? So the recession lasted like almost overnight and it was gone. But what I want to point out here is when the 10-year yields are yielding more than the 3-month, which is how a normal yield curve would be, these lines are staying above the zero line. However, when it dips down, when the line dips below this, what that means is shorter term maturities like treasury bills, 3-month, are yielding more than 10-year treasuries. Okay. Which, if you think about that from an investor standpoint, who wants to buy a 10-year for less yield when they can buy a 3-month for a larger yield? So that's what's an inverted yield curve. But what's interesting is, there's usually no saying about recessions start 12 to 18 months. Once it gets underneath the here, it's 12 to 18 months forward is when the next recession starts. But a more reliable indicator is this. Notice the pattern here, and this happens every stinking recession. We go inverted and we can stay under there for different periods. Look at the one we're in right now, how long we're under it. And the durations are never the same. It's never 12 months or it's never 13 months or 18. It's all over the place. But
well, it would be nice if they were the same every time, right?
Exactly, wouldn't it?
You're wonderful.
But what's interesting here is, notice when these gray boxes appear, what has happened is the yield curve is no longer inverted, has gone back to a normal yield curve. Notice that?
Yeah. Uninverting.
Yeah, they're going back to what they call a normal market. Exactly. So look what we're seeing. This is one of the deepest inversions we've had historically, but that's because of how much money was pumped into the economy, right? So anyway, this is the trend that we're in right now, because the 10-year yields have been going through the roof lately. And if you look at 3 months, they've pretty much just been going sideways. So now the trend is starting to go back up towards this. So I'm actually looking for like somewhere around the end of the first quarter of 24. I think that's when we're going to start seeing the recession's really going to come in and start feeling the pain. And we're going to, now remember, no one knows when we're in a recession until we're almost coming out of it, right? Because I do all these different calculations and, 2 negative GDP or 2 quarters of GDP and so on like that. But at some point they come up with some date and said that's when we started. But rarely do you ever hear anybody talking about we just started a recession today. It's always about, okay, it happened a couple of months ago. But anyway, the point is, once this comes up here and goes across this, that's when the next recession will start. And it's not kind of maybe, and we can all do, it's different this time. But how do you argue with this? As traders, we're pattern recognition people. When we see a pattern happening over and over and over, we shouldn't go against it, right? It's it's kind of like going up and shaking hands with somebody. And if they punch you in the face 5 times after they shake your hand, what are they going to do the 6th time? You know what I mean? It's the same concept. So why do people fight these patterns? I'll never know, because everyone wants to be like they got, so much of this college education, I guess you want to call it, or over education.
So they're going to outsmart the market.
Exactly. And no one's smarter than the market. The market is the king, right? Well, next to your wife, that's the first boss. The market is the biggest boss.
You met my wife. You met my wife. All right, cool.
I did, but I learned that is the smartest person in the world. But anyway, I just wanted to kind of point that out. But this is definitely, that's when these recessions are going to start. And that's what this article is all about right here. Just go into all that kind of stuff there. So since I wrote or taught for about 15 years, most of my articles have got content in there about, events coming up in the markets, but it's more about education as well. I try to give some education in there as well as, events that are coming up. As you can see, I do a lot of seasonality. That's probably the majority of my work when it comes to commodity trading. But it's interesting because seasonality goes into financial markets as well, which we can talk about that here in just a second. But soybeans, obviously really good seasonal patterns. Australian dollars, they've got some pretty good seasonal patterns because why? Their country is so dominated by commodities, right? So anyway, pretty interesting stuff when you tie in seasonality. And just like you were talking about the commitment of traders and so on like that. And for me, just technical analysis after that. I'm a big trend follower. I don't try and fade trends. So I try and go with trends that are in alignment with seasonal patterns. And like you were just looking at the commitment of traders, I try and get in sync with those managed money. And because when they start putting positions on, they got to stay on it for a long time. Technically, they're trend followers too. So I like to get in sync with all 3 of those, and then I got usually a pretty good trade setting up.
Interesting. So tell us a little bit about your feelings on the dollar right now. I mean, we're in a really obviously unique situation. This weekend didn't help anything. From people that are trying to fade this dollar strength. It is obviously very strong. Do you think the dollar strength is going to continue here?
I do. Yeah. I'll get that here in a second. Anyway, as we go through this article here, if you decide, you want to sort of follow me or whatever, up here in the right-hand corner, it's all free, and you don't have to sign up or anything like that, but just follow the author. Every time I write an article, which is weekly, you'll just get an email link, and then, you can go check out the article.
Great.
So anyway, right here's fourth quarter dollar strength and how to place your bets, basically. So when I just wrote over this weekend. Here we go. So there's some seasonal factors that come into play, which is, part of this. And I'm just playing again on patterns. And this is the US dollar seasonal pattern right here from January back to here. And this is more research. That's where I get my data from. And you can see for the last 15 years, that's what this black line represents. But this is coming into the fourth quarter right here. And notice it's like one of the strongest, percentage-wise moves we have throughout the year. So right here. So this is the one that I'm kind of interested in playing for this year. So just to sort of put a little disclosure or disclaimer out here first, anytime there's a seasonal pattern, they're never perfect, okay? So this is why we go back and we tie in technical analysis 1, uptrend, because we got to buy. I want to come in and look again. The commitment of traders report can give you a little bit like you want to see. I'm going to use the euro as the proxy on this thing, but you want to just kind of go, what's going on in the euro market? Because the dollar index, as far as futures go, has so little volume in it. I don't think, in my opinion, it's not worth trading when you got something like the euro futures or even the euro forex with so much liquidity in it. Why not just use it? So this is kind of what's got me excited about this. And then what I went into down here is about what starts all of this seasonality up here. Like, what are some of the seasonal factors? And for up in here, some of the stuff is, you can see there's some businesses right here. You get holiday season coming into the end of our year end or whatever. So all those imports that are coming in, well, then consumers go out and then they start purchasing all of these imports that came in, putting some strong dollar demand out there as well. There's also corporations that do sort of repatriation of capital, and some of that comes back into the country based off of year-end taxes, financial reporting purposes, whatever it might be. But that goes on at the end of a year as well. Obviously, we got market sentiment, which is going on right now. When you get an event like what happened overseas this weekend, that type of a stuff is going to put a little bit of a, okay, I don't see that ending between now and the end of this year. To tell you the truth, I think that conflict is going to go on a little longer, which is going to, I think, keep a bid in the dollar. Again, I'm just adding, my own opinion on something like that, but I just think that's what happened last night. We seem to have gotten quite a good of a bid there in the dollar. So anyway, we'll see what happens with that. Interest rates, okay, with the news that came out last week, I'll get down to here on that. If interest rates are still creeping up, that's still bullish for the dollar as well. And then just last week, okay, so economic data, obviously that impacts it. But when you look at things right here, like we just had that economic unemployment number came out Friday, and boy, what a surprise that was, right? 336,000. And then he revised the August up to 227. So when you see that, I mean, that just says that gave the Fed, I think, another green light. They can go ahead and raise interest rates that extra quarter point between now and, because they got the October meeting coming up. And is it December's the next one? Something like that.
In November, yeah.
November. Oh, I'm sorry. Yeah. And anyway, one of those, we're going to see that quarter point raise, no doubt. So again, that's just going to keep a little bit more bid in the dollar as well, I believe. So those are kind of the things right there that I think are going to really add to some of the seasonal pattern in here. And then down here, I just used, again, after writing about that, okay, so we got to strengthen the dollar, but here's the dollar index. And I just like to let people know, I'm surprised how many people don't understand how much weight the euro carries in the dollar index. And basically, you can take a dollar chart and turn it upside down and trade the euro. I mean, in my opinion, that's how close or inverted those two are, or inversely traded. So, but anyway, just the weightings that are going on in that. So if you see that weight that we have in there, and this is how you can use the euro to participate in the US dollar strength, basically. And that's what I was just writing in here. And again, just writing down some of the reasons why you might want to use the euro in place of the dollar. And I think we'd all agree the euro is probably one of the best currency markets to trade from a liquidity standpoint. Plenty of volatility, good trends. The currency markets have actually been showing some good trends this year, which is a refreshing thing, because I'm a trend follower and I'd really like to hear that. Anyways, here's a seasonal pattern coming up here on the euro, and we saw the one that was on the dollar up there. And more research is putting this out right here, that they're showing that on the fourth quarter right here, that on this particular trade, 14 out of the last 15 years, the euro is closed lower, somewhere in the vicinity of November 12th than on October 20th. Well, 14 out of those 15 years, like a 93% historical occurrence. And then 5 of those last 15 years never had a daily closing drawdown on this particular setup. So when you look at this, and it's going to be about 24 calendar days is the average, plus or minus a few days of how long that's going to last.
That's
so
interesting.
What we have here is a euro daily chart, and then the blue line represents where its 15-year pattern has been. Okay, and you can see, I mean, overall, it, despite this thing right here, what kind of threw us off a little bit. I'm trying to remember what it was going on back there, but anyway, when we had that situation right there, that kind of threw it off. But the overall bias, you can see it does tend to follow, except for this whole area here, but down, 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 and down. This is the next, just like the dollar, it's got a big move down. The euro does coming into this fourth quarter. And then we get this little pop up right here. So I wrote about that in the article as well, stating that we probably get some kind of a little pop up into here, which I wasn't planning on what happened over the weekend to happen. So you can see we got to start to that little uptrend that we had right here, but I think that's going to be short lived. Anyway, just a little pop up into here, and then the shorting come to here. So depending on how you play, do you trade sell rallies? For me, that's what I like to trade in. I like to sell into resistance in a case like this. Some traders will do breakout trades to the downside. But the key is don't just blindly come in and follow seasonal patterns, because I've tried that back years ago. I've been with them for since 2000. And I remember when I first started with them, I thought they were like the holy grail, and you literally could just sell here on that day and buy it on this day. But markets don't go straight to these places. I mean, they'll go up and they'll go down. You've still got to use technical analysis and your risk management, to get into these trades and manage them. So please don't take them blindly. That's probably the worst thing you can ever do. And it also just gives seasonality a bad name, because people come in looking for easy money, and there is no such thing in trading as easy money. So you better off apply your technical analysis and take advantage of some of these big moves like this. And what this window means right here is this is, let's say, shorting window, meaning sell rallies. If that's your style of trading, or sell breakouts during this period. It doesn't mean every day you got to be short, but at least during this period, it should give you a pretty good heads up. This has got a bearish window. I should be looking for selling opportunities. So depending on how long you're holding your trades, I don't think it does much for day traders, but definitely if you're holding positions overnight for, ever a few days to a few weeks, that's something to pay attention to. I use it as a screener. I think that's probably the better way to call it. As I scroll through on Sundays looking for upcoming events and so on, I look and go, what markets might be coming into some good seasonal windows? And I don't always use, just MRCI's data like this. I'll go in and do my own analysis. And one of them is, out of the whole year, what month usually makes the lowest low of the year for a particular market, and what months make the highest of the year. And those become significant times of the year I want to start taking positions in a market as well. So there's different ways you can play seasonal analysis, but it is definitely, for me, a good screener, and gives me an opportunity to go, dude, that market deserves some more analysis. So then I go in and apply, technical analysis. I don't do a lot of fundamental analysis, but I do, I look at macro events going on around the world, see what impact that might have on the market that I want to trade.
I think that's great, Don. And I know that seasonals are very intriguing to a lot of traders, because it helps them have a directional bias. Like, I'm like, if you're like, well, right now, this time of year, the euro tends to be more bearish, seasonally speaking. This is the chart you're showing us, the chart that suggests that. Yeah, it's like, okay, you got a tailwind, it's like you're not pissing into the wind, you're pissing with the wind, right? So, you got this tailwind working for you. So look to trade into that if you can. So I like
totally agree. Yeah. Why fight the tide? I mean, go look for the easy trades, well, easy is not a very good word in trading either, right? But yeah, but you're not fighting the market, try and go with it.
Exactly. Don, I think that's very, very interesting stuff. And I'm glad I got this opportunity to meet you today. And I'm glad I actually asked around, because I could have easily just said, yeah, hey, Don, if you're here, we'll get rescheduled with Dale. But no, thanks for being here today and sharing with us your work. So the way, so I can clarify this with everybody here, because I'm on the bar chart side. I'm actually on your article as you're speaking. Okay. You just go up to news, you select the author, which would be Don Dawson. In this case, that's you. Yes. And that's the best way to follow your work. And you're not on social media.
Yeah, I just do. I'm on LinkedIn, but I don't. I just don't do anything on social media. I'm not a big fan of it, to tell you the truth.
Oh, well, it's ruined the fabric of our society. So
unfortunately, I see a lot of kids that have been ruined by this stuff, but there's some good, I don't want to make it sound like it's all bad. I mean, there are some really good stuff out there, and I think Twitter's got some good stuff to it as well, but there's so much fighting and carrying. I don't care for that. So I don't like conflict. I guess is my personality. I just like, just put my opinions out there. You either like it or you don't. That's a nice thing about our country. Everyone's entitled to opinion, right? But it's I just don't like to get into all that, bantering and bickering back and forth about stuff, and Twitter is just full. I think it's just people looking for that. And I think it's that idea they can hide behind some kind of pseudo screen name, and just call you anything they want, or, knock you down as much as they want, because they go like, they don't know who I am. They can't find me. It's like
99% of the time they would never say it to your face.
Right. Exactly.
I mean, that's just the way it is. So
I totally agree. Yeah.
Unfortunate. But Don, hey, I want to say thank you so much for spending your time with us. I'm gonna track you down via email, and I'm gonna bring you on the Trader Summit one of these days, and we'll get a little bit more knee deep into some of your chart work. Sound good?
That is great. Okay, cool. And I'm just going to bring up that one thing when we first started talking when about the seasonality there. The financial markets, as I had mentioned, even the stock indexes, your interest rate products, all of those actually have a lot of seasonality to them as well. And part of it is because, like I was talking about, how that repatriation of the dollar at the end of the year by these companies, that's something they just do year after year after year. And as big as these companies are, that's what creates those types of seasonal patterns. In the interest rate markets, there's a seasonal pattern where the Federal Reserve the Internal Revenue Service and so on, they're taking money in from taxpayers at certain times of the year, so they don't have to issue as many bonds during that period of the year. So there's a downward swing in bond prices. It's so amazing how there's these patterns that are in the market, and they get called seasonality, but all they are is cyclical patterns that occur in the financial markets, just like they do in the grain markets, livestock markets, and stuff like that. So seasonality, it's a good thing. If you get a chance to do a little studying on it, I think you'll find it to be to your benefit.
And I really, really, really believe it's so prevalent in some of the markets you cover, especially when you're talking commodities, because commodities, they grow at certain times, and it's just, you have certain weather patterns. Really, really interesting and fascinating stuff, Don. So thank you so much from all of us here at the ForexAnalytix F.A.C.E community. Thank you for spending your time with us. And like I said, I'm going to track you down, and I'm going to have a little bit more dig in a little bit deeper conversations with you in the future.
Okay, well, thank you. I appreciate being on, and sorry for taking so long getting on. I just couldn't find the chat box to type the message in.
So it worked out perfectly. Thanks for being here, and folks, make sure you follow Don on Bar Chart, and Don, thank you so much for spending your time with us, and everybody, thanks for tuning in today. Sorry, Dale was out; he's got a power outage, but he should be back tomorrow, no problem. So you all have a great remainder of your day. For those of us in the ForexAnalytix community, I'll see you in about 15 minutes on the Morning Edge. All right. Thanks, everyone.